Well, this session's on strategic financial fundamentals. Then basically, I'm going to review concepts that'll help drive better decisions and better investments and have your team focused on the right things. Don't have to be accountants or financial people to know to get them focused on the things that can make a difference in your company. Well, would today be successful for you if you gained insight and exposure to some tools to make better resource management and investment decisions? That be fair? And specifically, what does that mean? The essence of financial investment analysis, the investments, insights to train all your managers on how they can help get superior profitability results. And three is capability to understand the balance sheet and the income statement a little bit better, a little bit more financial knowledge. Does that seem fair? Success for you? And your commitment is if you don't like it, well, don't tell anybody and please leave the session gracefully and quietly. But if you like it, share with some other people, try it. If you loved it, celebrate, tell everybody, come to more of my sessions and these sessions, and hey, consider calling me if I can help you and your team. So let's get some core basic concepts down. All right. You won a lottery ticket, let's say. And the concept is different perceptions of the same thing. So let's say won this $100,000 lottery ticket and you go, man, I'm rich today. But you don't need the money right now, right? And you get two investment options, two really good friends. Friend one, wow, she's an exceptional hairdresser. She goes to me, hey, Dave, loan me the 100,000 and I can start my own salon. Hey, I'm ready to be an entrepreneur and I'll pay you back in 12 months, your $100,000 plus. I'll give you an additional $5,000. Friend number two is a banker says, whoa. Deposit that $100,000 in our money market. It's paying 5% right now. At the end of a year from now, you'll have 105,000. Note, they're both a 5% return on the 100,000 investment. Which one are most people going to take and why? Well, you know the answer. So the core concept is in the game of business, all decisions have a different risk versus reward. So you have to look at each decision and say, what's the amount of risk and what's the amount of reward I need for that risk? And the higher the risk, the more rewards required. And the lower the risk, it requires less reward, less return investment. So what's the implication in business? Well, basically, you add value in one of two ways. You either lower the risk, because if you lower the overall risk, the amount of return they need back, whether they're banks or shareholders, the less they're requiring. Or you increase the return without changing the risk. And either way, it's a return on investment. All right, let's go a little further. So how do you get there? What are the implications to lower risk and how do you add value as a leader? Well, you do an analysis, communication. You think Chessers. And oftentimes it's done through a SWOT analysis. You've probably seen that. Your internal strengths and your, frankly, internal weaknesses. And you compare that to the external opportunities and external threats. And you think chess and you look at the analysis, but you communicate back to people checkers, just the really important parts. Don't overwhelm them. And what are you trying to do? You're trying to optimize improvement by lowering over risk or improvement by increasing a higher reward. So I'm going to get a little more sophisticated here, but to show you how Wall Street plays, how the game's really played, all right? And I think of it as what's it cost theoretically to get the money to play the game of business, all right? And if you can get the money to play, risk versus reward, and you use the money to play and you do better than your cost of capital, the cost to play, you can go back for more. And if you can't run the business to return what you promised, risk versus reward, to either shareholders or banks, and you go back for more, they're not going to give it to you, right? So here's an example. We got the cost of equity. So let's say Joe owns a roofing company and needs an additional $1 million investment, and he has 500,000. All right, so that's half of it. And he says, look, given I'm taking the risk, I need at least a 15% return in his company, because if it's less than that, he might be better off investing outside the company at something lower risk. So the debt is going to be the other half of the million. He's putting in 500,000. He's going to the bank for 500,000. The bank says, hey, that's 8% interest that we need. All right. Because they believe the risk is somewhat low, but why is debt always cheaper than equity? Because if anything goes wrong, banks get their money out first. So it's lower risk. All right. So they're willing to give it at 8%. And assuming the company's in a 25% tax bracket, so that 8% really cost 75% of that. All right. So 6% after tax. So what's the cost of capital? Well, equity is 50% of the money, and it needs 15% return. And that's a hypothetical number. Some companies, that could be 25, depending on the risk of that business. And the debt's putting in 500,000, that's 50%. So if I take 50% of each one, the cost to play is the combination, which is 10.5%. And so that's the cost to get money to play. Now, if we go play the game of business and equal or exceed the 10.5, we can keep going back for more. And if we can't, no one's going to give us more. And that's the key of how the financial game is actually played. So let me give you an example in different industries, right? Typical public utility, it's super low risk. They generally pay closer to 3% return. Most manufacturers, it's at least 4 to 5. Retail, at least 5 or more. And high tech, even higher than that. And equity, again, risk versus rewards all over the place. So public utility is the least risk, manufacturer might be the second, retail third, and high tech fourth. And when you go through it all, over to the right is sort of ballpark, different industries, different companies within might be different, but it's sort of the cost to get money to play. All right. And because public utilities are so low risk, they load it up with a lot of debt. And since high tech's high risk, there's a lot more shareholder money generally in there. All right. So you might be saying, well, if debt costs less, why don't I just do more debt? Well, there's something called a debt cap or debt capacity. So debt is capped, usually at a number that the debt holders don't want to take risks. So they determine their conservative best guess of the cash flow that you can generate from the business in every month. And they go to the worst case number in that cash flow and say, that's how much we know we'll get out. Therefore, that's how much debt, interest and principal, this company can afford and may not take any risk. And that's called a debt cap. All right. Now, do you always want to maximize your debt cap? No. Let me give you an example at GFY. I didn't want to always maximize it. We were a very opportunistic acquirer. Now, we had a fair amount of debt, but we didn't use all the debt we could get. And the reason is this. If a major opportunity came up, equity, selling stock, takes a lot longer to go through the entire process than going to the banks and getting debt. So I didn't want to use up all the debt. So there's opportunities came up. I knew I could quickly raise the money. And that's how the whole debt thing works. All right. So the question is, well, how well do we play? And it's all about the investor's return on their investment, which is the cost of play. There's two types of investors: the shareholders, which is a lot higher risk, and banks, which is low risk. They both invested and taken risk in our company. And the total amount of that long-term debt and equity, they're both investors, and that's going to blend the two to the cost of capital. Now, if we play and generate a total investment return that's better than the cost of capital, we're able to pay the investors what they required, and so we can likely go back to for more. So how do we see how well we played? Well, the return part is from the income statement. You get sales minus cost of goods sold equals gross profit. You subtract the general operating expenses, you get earnings before taxes, and basically it's operating income. You got depreciation, which you add back because it's not cash. And that means the company is sort of, the basic cash flow is EBITDA. And EBITDA is earnings before interest and taxes, but depreciation is added back. So you're getting a sense of what cash is being generated, and that cash is used to either A, pay the debt holders the interest and pay back the loan, or 2, invest back in the business, or 3, pay interest, or 4, buy back stock, or 5, pay dividends. There's 5 things you can do with cash. And the balance sheet, which is the bottom number of the equation, is the investment. So if you think about it, the investment is the combination of long-term debt and equity. And if you look mathematically, long-term debt and equity have to equal total assets minus short-term liabilities, and that's called net assets. But the reason you want to focus on net assets is that's where you want your company, you and the employees, focused on how do we improve them. And we improve them by lowering as best we can the amount of investment on the asset side, and on the short-term side, maybe increasing a little bit. So we're trying to minimize net assets required, because the lower the net assets, the bottom number, and the higher the top number, which is from the income statement, the better the overall return. Okay, so it's called RONA, right? RONA happens to equal return on investment. Investment is long-term debt plus equity. But the reason RONA is it gets you focused on the right things, which is amazing, because in school they don't really teach you this, but on Wall Street, whatever, they talk about RONA all the time. And the math is the return, which is the operating income, right, before interest and taxes, divided by the investment, which is from the balance sheet. And that's how well we played the game. And if that's higher than our cost of capital, the combination of what we have to pay investors and debt holders based on the risk versus reward of our company, if we can do that, we'll get more. And if we can't, it's going to be tough going back for more. So why focus on RONA? Well, because return on investment sometimes means different things to different people. Sometimes it's the same as return on equity, and sometimes it's return on a combination of equity and long-term debt. And I like to think of it more that way, because equity plus long-term debt, they're both a total risk, and that's what's invested, and that's where the overall average cost of capital comes from, and that's the number I got to beat, and that's why. But since it's two different definitions of ROI, we're better off using RONA, which happens to equal the same thing. RONA is total assets minus short-term liabilities, happens to equal long-term debt plus equity. All right? And remember, using that, we get the cost of capital. So let me give you an example. Let's take Costco. I just looked it up. Their earnings for interest and taxes was $9.29 billion. Here's their total assets of 69 billion, short-term liabilities. So the net assets is 34 billion. The long-term debt is close to 11. And the combination of shareholders' equity, what was invested plus retained earnings, all right? And so the amount at risk is 34 billion. Well, that means the 9 billion divided by the 34, that's a 27% return on investment, which is why Costco continues to be a really good investment. So in a nutshell, the game is, what's the cost to play from debt and equity, getting their return based on the share of the total investment, and how well did we play? And the return is the operating income from the income statement divided by the investment. So summary of the game. If RONA is equal or greater than the cost to play, you can get more and grow. Now, there's also this same concept inside a company. So I'm going to give you an example within Johnson & Johnson when I worked there. It was a new product. It was very high risk. A lot of new products don't make it. So the corporation, I only figured out to get my projects approved, I had to demonstrate that the company was going to get at least a 35% return. It was adding capacity because we're doing real well. That was a lot lower risk. I needed to demonstrate a 20%. And if it was immediate reduction of my cost of goods sold, I only needed a 12. Again, risk versus reward. And companies want a combination of various types of risk reward investments, so it's a balanced portfolio, just like your own investments might be balanced. But here's the important part. Forget being an accountant, forget financial, forget all this stuff. The key is, well, what does that tell me on how I add value? Well, I add value in one of two ways. I can decrease the cost to play. And the way I do that is I demonstrate that the risk for my business, the risk of being able to pay them back, is lower risk than they thought. And if it's lower risk than they thought, the banks might take a lower interest rate and shareholders might take a less return as their perception of what they're going to get return on their investment. But most of the game's played on the other side. And this is why I like RONA, because it gets you focused on the right things. And what does that mean? Anything I do to increase income, the top number, or anything I do to decrease investment, the bottom number, theoretically adds value. Well, how do I do that? Anything that decreases cost of goods sold or increases sales or lowers expenses, with all other things not changing, that increases income. I've added value. And the investment side, which most managers don't look at, but it's really key. Anything I do to decrease assets overall or increase my short-term liabilities, payables, in other words, let my vendors sort of give me a free loan, I've added value. So what's the equation again? The numerator comes from the income statement. That increases return. The bottom number comes from the balance sheet. The lower the investment, that increases and adds value. Let me go one more step. So the game, well, who typically cares about what? Well, leaders of major companies, they want to know how well we're performing. So two major measures that they use are EBIT, the operating income, or EBITDA. How much cash am I generating? Because how much cash I'm generating at a senior level, I get to make 5 decisions. I can pay back loans. I can invest more in the business. I can pay taxes, right, which is affected by the interest I pay. I can buy back stock, or I can pay dividends. Vendors look more at the debt. And there's 2 major ratios they look at. One's called the quick ratio. One's called the current ratio. The quick ratio is I take cash and receivables, the assets, and divide it by how much I owe short-term liability. And that gives me my quick ratio. That means, hey, I can convert cash and receivables pretty quickly, and I can either meet or I have a buffer to pay my short-term liabilities. And those who are more a strategic vendor may also look at the current ratio. And the only difference there is it adds inventory. And why is that? What's important there? Well, I can't turn inventory into cash generally as quick. So it's just another more cautious way to look at the equation. But what are they both designed to do? What's my risk? What's the ability to pay? Now, shareholders have different views, right? Is the price earnings ratio, that's the value of the stock. There's the EBITDA multiple. Most companies in acquisitions are based on EBITDA because what you're really buying is the cash that's generated by the business. The debt equity ratio says how much risk we're taking, how much leverage. And the market cap, the book value, is the overall value of the company. So what are some rules of thumb? They don't always hold up, but in general, Wall Street healthy, the average PE is in the 14 to 17 range. And EBITDA, retail, it's lower than that. Retail stores generally go 5 to 7, manufacturers 8 to 12, high tech 20 plus. Roofing generally goes smaller companies 3, 3.5, a little bit bigger 5, some go as high as 7. Then giant companies like a Tecta, it might be up to a 12. All right, rules of thumb. So let me go another place here. So you've probably had, I've found in my career, salespeople, when they don't make the sale, it's one of two reasons. One, they say my price was too high, or two, we don't have what the competitors have. And frankly, I learned in management, if I want to get a salesperson out of my office, I just told them the price is too high or you don't have what the competitor has, because otherwise they won't leave my office because it's their fault on selling the value if it's not price or competitive. So you've probably been asked, well, if we look, you've heard from salespeople, and I love sales, so they generate the stuff, and I've been in sales. You've probably heard things like, if I lowered the price by a small amount, I can sell a lot more. So what do I do? So I ask them, well, how much more? So let's say, for example, my current gross profit divided by sales, which is margin, is 28%. Let's say, Dave, if we only lowered the price by 5%, I could sell a lot more. So I take the 28 minus the 5 is 5, and I divide that, and that means I need to grow 22% to get just the same amount of profit. More stress, more people, more equipment, whatever. And that's a lot higher number than most people think. I take that a step further. So I give you a chart. And let me show you how to use this chart. So in the top part, let's say I have a gross margin, we'll call it roofing, of around 30%. If I drop my price by 6%, I got to do 25% more business to make the same amount of money, but 25% more headaches. Now, if I can, let's go to the other side. If I can increase on a 30% margin my price by 5% by selling value better, I can lose up to 14% of the business and be the same. But if I lose less than 14, I'm making more money. And what's this chart always told me? I generally make more money figuring out ways to sell more value better. And that's the key. So let me give an example of all this. We're going to call this company, it's a small roofing company, we'll call it. The name of the company is Ton Stoffel. All right. And let's try some numbers, right? Net sales are 5 million, cost of goods sold 3.5 million. So it's a gross profit of $1.4 million. Fixed cost of $1.1 million, variable cost of $200,000. They don't have any debt, so there's no interest. So total expense is $1.3 million. Their profit before tax is 100,000, and the profit after tax is 70. They're in a 30% tax bracket. Then we look at the balance sheet: cash, receivables, inventory, other assets, whatever. And most people will look at this and say, I don't know what to do with all this. Well, let me show you what I do with it. The first thing, I want to convert everything I can to percents because I can get my arms around what that means. So cost of goods sold is 72%. Okay, now I got a feel. And my gross margin, which is the opposite of that, what's left over, is 28%. All right, I got 28% gross profit. And as a percent, it's gross margin. Gross profit's always dollars, gross margin's always percent. A lot of people don't know that, but that's technically right. I get fixed cost is 22% of my sales. Variable cost is 4% of my sales. No interest. The operating profit's 2%. Profit after tax is 1.4. I'm getting a better feel. Oh, wow, that's not a lot of profit. But then I go to check, well, what's the balance sheet look like? Well, the total assets is a billion, $1.25 million. The net assets are $950, but accounts receivable, I'm collecting in 29 days. That's pretty good. This, by the way, was a residential contractor, but they got a lot of inventory. They got 80 days worth of inventory. They do a lot of large projects, and they're paying right on time, 30 days, right? And the equation's over here. Right? To get accounts receivable days, accounts receivable divided by sales. To get inventory days, it's inventory divided by cost of goods sold. Payable days, because it's the vendors, it's accounts payable divided by my cost of goods sold. All right. Now a profitability analysis. My return on just the equity is 7.4%. My return on the net assets, RONA, happens to be the same thing. The reason is I have no debt. So total investment is all equity. Now, if you were an owner making 7.5%, would you think twice about putting more money into this company versus some other investments? Yeah, you might, until you can make this company a little bit better, because that's not a high return for the amount of risk I'm taking. By the way, that's not an unusual number for a lot of contractors. But let's see the effect of small changes. This is what I mean about getting your team focused on the right thing. They don't have to know all the math. If we can say, okay, let's focus on decreasing our cost of goods sold. Right now it's 72%. Can we just squeeze 3% out of that? How might we do that? How might we get it from 72 to 69? And now everybody's on deck. How to get that 3%? That's now doable. And they say the inventory, right now we're 80 days. Guys, can we get it down to 70? Just 10 less. Receivables, can we improve it just by 2 days? 29 to 27. Can we stretch our suppliers just a little bit? An extra 5 days. And maybe let's add a little bit of long-term debt, which is a lower cost return, right? Because it's lower risk. Let's just do $100,000 in long-term debt. Those are pretty small changes, right? Well, let's look at the effect. Initially, I had a return of 7.5, right? But from these small changes, my income goes up 145,000, right? The sales times the 2% drop. And I got a little bit more because I'm paying after-tax dollars on the debt. It's 5,000. But look at the reduction in the investment. The value of the inventory, that's $100,000 less invested. The accounts receivable, just the 2 days, is an extra 27 less investment. The increase in payables by 5 days is worth 50,000. So in total, we've decreased the investment by $178,000. So what effect does that have? My return on net assets went from 7.4 to 27.8. My return on equity equity, just the shareholders went from 7.4 to 25.3. And if I'm making 25% of my money, am I going to invest as aggressively in this company as I can? Yeah. Notice we don't have to be finance people. We don't have to be accountable. We have to know what's going on. And the point is, small changes, just very small changes, can make a big difference in the results. So the game of business, profitability, how well did we play? Top number is profit after tax divided by the bottom number, which is the investment, which is, how much the investors, banks, and shareholders have at risk, or equals the same thing, net assets, total assets minus short-term liabilities. Hopefully you see why I like that, because it shows me where I need to focus to add value. Lower the asset side, investment, increase the short-term liability side, that's net assets. If I'm focused my team on that, they don't have to understand the math, they have to understand this is what drives value. So I create value when sales go up, cost of goods sold go down, or expenses go down. I create wealth when I decrease to run the same amount of business, the amount of cash I need, the receivables I need, the inventory I need, and the fixed assets I need. Where do you find them? Income statement and the balance sheet. Forget the math. Focus your team on these concepts. Simple. Everyday reminder to all your employees. Every day, everybody can add value, which creates more opportunity. And what are the core 5? How can we reduce accounts receivables? Well, one way is the happier the customers, they generally pay quicker. When they're not happy, I can always tell when we get a quality problem, because all of a sudden receivables take a quick jump. So guys, make it a great experience for your clients. Smile more, appreciate more, stay in touch with them more, share information more. People remember what they don't expect. And in today's world, they don't expect appreciation and staying in touch and sharing helpful information. And that can affect receivables. They'll treat you a little bit better. Reduce the inventory at hand, quicker processes or production or services, more effective ordering, consolidation, offering less things, combining SKUs, maybe pre-assemble some stuff before you bring it on site. What about decreasing cost of goods? Well, labor goes into that. Can we do it by saving time? Can we do it by preventing problems before they happen? Can we do it by reducing waste? Can we negotiate better? But increasing sales, are we doing everything we can to ask for more referrals, ask for more opportunities, maybe raise the price a little bit and focus more on selling the value that they'll appreciate? And frankly, what we don't like to do, cold calls. And measure it. What's in view is what people do. If you're not measuring it, you're likely not improving it. By the way, what does TANSTOFL stand for? There is no such thing as a free lunch. Now, as a reference, I gave you some basic financial different ratios, but don't memorize all the ratios. Understand they're all designed to do one of two things. Track how I'm doing on the income side. Are there any trends there? Are there any things I can do to get that up just a little bit? Other ratios, tracking them to see is there anything I can do to decrease the investment just a little bit. And all these ratios, they're just trend lines to say, is there anything that went out of whack, sort of like a dashboard on a car? And is there anything I can tweak to squeeze a little bit more out? So summary financial fundamentals for better decisions. Yep, do the math, but avoid absolute numbers, which is what accountants love to share, right? The lesson is it's all about risk and return, right? The lesson is all about earning from playing the game of business more than the cost of the money to play. And frankly, a lot of decisions, a back of the envelope number can get you a long way, and it might be all you need. It's all about leverage, ability to Okay, shareholders, they require more. If I can offset that with debt costs lots more. It lowers my overall cost to play. It's easy to run a company with a lower cost of capital because I can go back for more. And the other lesson is affecting sell price down is dangerous. Selling value is usually easier to figure out how to tweak that. So that's a little bit of my background. And you agreed. If today was successful for you, you gained some insight, exposure to a tool, better to help you with resource management investment decisions that, specifically financial investments, the essence, the investments, insight to train everybody else where to focus for superior profitability, and frankly, the capability to understand the balance sheet and the income statement a little bit more. Well, if you're still here, you probably liked it at least a little bit. And you said if you liked it, you'd share it with some other people and try it. And if you loved it, celebrate. Watch more of my sessions. Tell everybody. And consider giving me a call if I can ever help out. Thanks, everybody.